Hello, everyone. This is Mark with Semantics Research with your daily market report. So, today we had a pretty boring, choppy market as we enter the eighth day of balance. And for the time being, the market really lacks direction. So, we are setting up for a larger move technically, but currently we are in a massive consolidation without any strength or weakness to either side that it could choose a direction. So you could compare this price action similar to a rubber band where either side tries to break out of this consolidation and it drags them right back in. With CPI coming out this Friday, it probably won't do much in terms of market movement. I'm not quite so sure that the hedges will unwind, as there is about 3.2 trillion in options hedged. If the CPI doesn't move the market, then perhaps maybe the FOMC or the 17th of this month expiration. But if we don't get any juice out of these events, then we might have quite of a boring snooze market that will probably frustrate many momentum traders until the next GDP number, which is in a few weeks, where we might see some movement. Overall, the market had 10 of the 11 sectors closed down, with only the energy sector being positive today. We had some contraction in the VIX slightly, but not much. But what is very interesting to look at is VVIX, which is a CBOE measure of volatility on VIX, has dropped to its lowest level since February of 2020, which is quite interesting, and perhaps it is signaling that the market has been discounting most of the negative news and sentiment, and we are beginning to settle into a period where recession fears, company downsizing and bad guidance, energy prices being high, has been accepted by the market, and everyone is quite numb to these negative headlines that we have been seeing. So we probably won't see any further bad news shake the market unless we see something drastic or wildly unexpected. We do have Janet Yellen stating that she is hoping that inflation has peaked and the worst is behind us, but I do not think it's likely, as inflation will probably remain sticky. It could be a sort of a new system or order where we deglobalize and continue to have sticky, stubborn inflation. It's quite similar to the 1970s, but not quite, economically speaking, as the context is much different. And we also have the White House spokesperson Jean-Pierre stating that they expect the inflation numbers at the end of the week to be elevated. So I guess they're setting up the expectations to be rather negative. Now, if we look at the mortgages, we are starting to see a cooling of the housing market that has run up massively in the last 2 years. Mortgage applications were down to its lowest since the year 2000, and we are starting to see a bit of demand destruction where housing prices have become less affordable for the average American, as we are seeing mortgage rates that are slightly higher, but it is still lower than before the pandemic. But that is something to be watching as the Fed continues to raise rates and be aggressive. Now, going into commodities, it seems like the move in natural gas was due to players taking profit on their gains rather than being related to the LNG explosion in Texas, as that would generally cause upside moves because, when you have attacks on oil pipelines in the Middle East, that is generally a bullish pressure on energy. Another potential pressure to commodities is that as people exit equities, we might see, due to underperformance, we might see these investors start purchasing commodities or commodity related equities to hedge against inflation. And this could actually cause a spiral and continue to push commodity prices higher, thus worsening inflation. And I don't see any lessening of inflationary pressures on commodities unless we see oil prices drop for the right reasons. And that possible positive scenario could be if we have a resolution in the Ukraine war, which is still unlikely as both sides are not agreeing to any terms, and this negotiation has really gone stale, and it seems like we are probably going to be in a prolonged conflict. But if we do get a drop in oil prices that is significant, then that could ease the consumers' woes, and they'll be able to spend money on other things. If you look at consumer debt level, it continues to rise, which is setting up us for a very interesting scenario, as consumers are taking on high amounts of debt to pay for inflated prices. And right now we do have low rates, but what happens when the rates go higher and they have to service their debt? It could worsen the situation and make things quite ugly. But yes, and that is it for today's daily report. I thank you all for watching, and be sure to check out the link in the description for more updates. Thanks again.